Welcome everyone. Today we're going to discuss about one of the important aspects about macroeconomics, and this is about monetary policy. How government regulate a availability of a credit and they regulate the banking system. The FED uses three main tools, mostly influence in interest rate and the money supply. Financial contagions. When fear that one bank is insolvent spread to fears that other bank are insolvent can cause bank runs to occur at multiple banks. Uh, Illiquidity. When the demand for cash by depositors exceed the bank's available reserve. Insolvency. When the value of a bank asset is less than the value of its liability. Bankrupt. Loan finance. Bank earn income by making loans. They also make other safe investment like purchase of treasury security, but primarily they are in the loan business. Bank are one part of the large financial system which links savers and borrowers. Savers supply the fund for borrowings and borrower provide the demands. A key element between lenders and borrower is the interest rate, which is the price one pays to borrow money and the reward one receives for lending. Bank run. If the bank is still solvent, it could attempt to uh, fast sell prices. Sell bring is less money than the asset are worth. That would be enough to pay off enough deposit to stop the run. Bank run are raised on emotion as much as logic. The bank could try to borrow a financial market, but who is likely to lend to a bank in a financial crisis? Central bank institution who's conducted a national monetary policy and regulates its banking system. Federal Reserve, the central bank of the United States, run by a seven-member board of governors in junction with 12 regional Federal Reserve Bank in order to help financial system operate smoothly and to reduce the likelihood of financial crisis. Most modern nations have a central bank. The Federal Reserve, unlike most central bank, is semi-decentralized. It is run by a board of governors, consists of several members appointed by the President of the United States and confirming by the Senate. What does a central bank do? The Federal Reserve, like most central bank, in design to perform three important functions. Number one, to provide banking service to commercial bank and other depository institution, and to provide banking service to the federal government, to promote stability of the financial system, to conduct monetary policy. Bank regulation is in state to maintain bank solvency by avoiding excessive risk. Regulations fall into a number of categories, including reserve requirement, capital requirement, restriction of the type of investment bank may make. Bank capital is the difference between the value of a bank asset and the value of its liability. Regulation required that bank maintain a minimum net worth, usually expressed as a percentage of their asset, to protect their depositors and other creditors. Deposit insurance and lender of the last resort. The risk of a bank run credits instability in the banking system. To protect against bank run, Congress has put two strategies into place. Deposit insurance program, which insures commercial bank deposit up to the 250,000. Dollar per bank in the US. An insurance system that makes sure deposit in a bank do not lose their money even if the bank goes bankrupt. Lender of a last resort. Role of the federal to provide loan to distressed bank when the bank cannot obtain credit from anywhere else. Discount rate. The interest rate charges by the central bank of the loan that it gives to other commercial bank. Federal fund rate. The interest rate and interbank loan. Open market operation. The central bank selling or buying treasury bond to influence the quantity of money and the level of interest rate. Reserve requirement. The percentage amount of its total deposit that a bank is legally obligated to either hold a cash in their vault or deposit with the central bank. How a central bank execute a monetary policy. Monetary policy operates through a complex mechanism, but the basic idea is simple. The federal supply reserve to the banking system, which affected the availability of the credit generally. The central bank has the three traditional tools to implement monetary policy in the economy: changing the discount rate, which is interest rate charges by the central bank on the loans that is gives to other commercial bank; changing reserve requirement, which determine what level of reserve bank is legally required to hold; open market operation, which involve buying and selling government bond with the bank. In the event of a bank's run, sound bank could borrow as much as cash as they need from the federal discount windows to kill the bank run. The interest rate bank pay for such loan is called the discount rate. The Federal Reserve was originally intended to provide credit passively, but the yearly since its founding, the Federal has taken on a more active role with monetary policy. A second method of conducting monetary policy is for the central bank for the raise or lower the reserve requirement. If the Federal were to raise the reserve requirement, bank would have to hold a greater amount in a reserve. Small change is the reserve requirement are made almost every year. Large changes is reserve requirement are rarely used to execute monetary policy. A sudden demand that all banks increase their reserve would be extremely disruptive and difficult to comply with. Open market operation, the central bank selling or buying treasury securities to influence the quantity of money and the level of interest rate. Open market purchase, the central banks buys treasury securities to increase bank reserve and lower interest rate. Open market sales, the central bank sell treasury securities to decrease bank reserve and raise interest rate. Open market operation take place when the central bank sells or buy US Treasury securities. When the Federal conduct open market operation, it targeted the federal fund rate. Decisions regarding open market operations are made by the Federal Open Market Committee. Capital market, the market for the long-term financial asset. Contractionary monetary policy that reduce the supply of money and increase interest rate. Expansionary monetary policy that increase the supply of money and reduce interest rate. Federal fund rate, the interest rate of which one bank lend fund to another bank overnight. A market fund, loanable fund. A broad new view of the financial market include equities, bond, bank account, credit, all other financial asset. Money market, the market for the short-term financial asset. Prime rate, the interest rate bank charges their best corporate customer borrow with the strongest credit rating. Expansionary monetary fund policy aggregate demand and the level of economic activity by increasing or decreasing the availability of the credit. An open market sale by the field reduce the amount of reserve in the banking system. Through open market operation, the central bank changes bank reserve in the way which affect the supply curve of a loanable fund. Where the federal decisions of the conduct and expansionary monetary policy, financial market display wide range of interest rate. In general, when the federal fund otherwise the rate drop too, and when the federal fund rate rise, other interest rate rise. Monetary policy and aggregate demand, monetary policy offer interest rate and the availability quantity on loanable fund, which in turn into several component of aggregate demand. Business investment will decline because it is less attractive for firms to borrow money. Country cycle, moving in the operation directions to the business cycle of the economy, downturn and upstreams. Federal fund rate, the interest rate of at which one bank lend funds to another bank overnight. Quantitative earned, the purchase of loan agreement government and provide mortgage background securities by central bank to make credit available in the host to stimulate aggregate demand. Episode 1, 1970, the rate of inflations were very high, so the Federal Reserve uses tight monetary policy to raise interest rate. Episode 2, 1980, when the Federal Reserve was persuaded in the early 1980s that inflation was declined, the Federal began slash interest rate to reduce unemployment. Episode 3, late 1980s, early 90s, inflation appears to be creeping up again. The Federal Reserve used contractionary monetary policy to raise the federal funds rate in 1987 to 9.2 in 1989. Episode early 90s, the Federal Reserve were confident that inflation was back under control if reduced interest rate. Episode 5 and 6, the Federal Reserve perceived a risk of inflation and raised the federal funds rate from 3% to 5.8% from 1993 to 1995. Episode 7 and 8, Federal Reserve conducted a loose monetary policy and slashed the federal fund rate from 6.2 2000 in just 1.7 in 2002. Episode 9, 8, Federal Reserve was quick to slash interest rate, taking them down to 2% in 2008 and to nearly 0 in 2009. At the beginning of the Great Recession of the Federal Reserve Fund itself, in a precise positions, the Fed began conducting quantitative easing. The Fed also tried alternative way. The Federal made more aggressive use of purchasing agreement, while not technically monetary policy if we are seeking strictly. So if we focus on the review of this chapter, what we find? We find what are the key role of the banking in bringing lenders and borrower together. How does the nature of bank make them skepticals to bank run? What is the structure and organization of US Federal Reserve? How do central banks impact monetary policy? Explain bank supervisor measures taken to reduce the risk. How are deposit insurance and lenders of at least resource true strategies? What are the federal three main policy tools? Explain and demonstrate how the central bank execute monetary policy by changing the discount policy. Explain and demonstrate how the central bank executes. Explain and demonstrate how the central bank execute monetary policy. Construct expansionary monetary policy. How does monetary policy impact interest rate? How does monetary policy tools work? Explain and show how monetary policy impact aggregate demand. Evaluate Federal Reserve, as well as what is the significance of qualitative earning, QE. So these are the basic way that we can understand, we can learn, and we can grow in an effective way. So I request everyone be focused on the monetary policy right now in COVID period, and if we can understand and move with this policy, then we can move in a professional way. So thank you everyone for joining today's session. If you have any question or anything, you can ask me. Thank you.